Hello, welcome to Wealth and Wisdom. My name is Martin A. Smith, and I have over 15 years experience as a wealth management advisor serving the needs of investors and families throughout the Maryland, D.C. area. I want to thank you for tuning in to Wealth and Wisdom as we continue in our topic of what is bear markets and how to manage in a bear market. Today we're going to discuss portfolio diversification and why diversification in and of itself might be the reason why people lose money in their portfolios during bear markets and or recessions. In the previous episode of Wealth and Wisdom, we discussed an important point for you to learn, which is that volatility and periods of uncertainty typically are not abnormal. I say typically because while the U.S. economy tends to follow a general cycle that is marked by periods of recession, trough, recovery, expansion, and peak, we should always leave room for human nature, also known as event risk, such as corporate scandals, national wars, that sort of thing. Remember, event risk falls outside of the norm of what economists refer to as the economic cycle. So rather than fear market downturns, we must factor them into our overall long-term financial strategy because they will most likely happen again and again. Our goal on this show is to introduce you to concepts and ideas used by professionals to help you manage the impact of the stock market volatility, as well as to equip you with wisdom to help you build your investments through both good times and bad. Let's go to the slide that shows today's topics. Today, we're going to discuss, one, what is an asset class? What exactly is an asset class? And secondly, what is the difference between asset allocation and asset class diversification? Very important. So first, come back to me. Now, what is an asset class? Before you ever invest, you should have a basic understanding about asset classes, what they are, and pretty much how they tend to behave in response to the economy. So your first question should be, what is an asset class? An asset class is a group of securities, stocks, bonds, cash, equivalents such as money market instruments that exhibit similar characteristics. They behave similarly in the marketplace and are subject to the same laws and regulations. It should be noted that in addition to the three main asset classes previously mentioned, some investment professionals would add real estate and commodities and possibly other types of investments as well to the asset class mix. Whatever the asset class lineup, each one is expected to reflect different risk and return investment characteristics and will perform differently in any given market environment. Asset classes and asset class categories are two different things. Asset classes and asset class categories are often mixed together. In other words, describing such as large cap stocks or short-term bond asset classes is incorrect. These investment vehicles are asset class categories. Okay, it's important to note. Again, large cap stocks, short-term bonds, asset class categories. And they are used for diversification purposes. The next foundation stone of successful investing is diversification, not putting all of your eggs in one basket, or what I refer to as the importance of security correlation. Now, this next slide we're going to go to illustrate this point. What does security correlation mean? And what exactly is security correlation? You notice that the image on your left in the orange box, it shows line A and line B traveling pretty much in the same pattern, okay? We call that positive correlation when you have a diversified portfolio, so to speak, but everything seems to move in the same direction. Now, the next box, which is blue, has the white dotted line diagonally going up to the right, and you can pretty much see a zigzag line on either side. That's called inverse correlation. That's an example of a portfolio that is properly diversified. Some things will move up, some things will move down. So what does asset allocation mean? Asset allocation is an investment strategy that aims to balance risk and reward by apportioning a portfolio's assets according to an individual's goals, risk tolerance, and investment time horizon. The three main asset classes, as we mentioned earlier, equities, fixed income, and cash equivalents, they have different levels of risk and return. Each one will behave differently over time. There is no simple formula that can find the right asset allocation for every individual because people are different.